we are jumping straight into Ondas Holdings today. If you've been tracking the wild volatility of this name, you know the price action is intense. But for you, the real story isn't the daily swings. It's the massive, tangible acceleration happening right now inside their autonomous systems segment. We need to unpack this immediately because the numbers are, well, they're stunning. The company just reported Q3 2025 revenue that surged an astounding 580% year over year. That's a jump from just $1.48 million to $10.1 million in a single quarter. That type of explosive momentum isn't just noteworthy, it forced management to raise their full-year revenue guidance significantly. We're talking from $25 million all the way up to at least $36 million. That growth isn't speculative, it's a realized catalyst.
Exactly. We understand you need to cut through the noise and volatility to understand what is genuinely driving market moves. I'm glad you're with us. This is fundamentally a story of transition, moving from being viewed as a future concept to a company with powerful present-day order flow. That operational shift is where we need to focus our analysis.
If you are enjoying this breakdown, make sure to subscribe and hit the like button. It really helps the channel reach more people like you. And definitely let us know in the comments which stock or sector you want us to simplify next.
All right, let's look at the core bull and bear case for Ondas Holdings right now. If you're building a bullish argument, it absolutely must begin and end with the autonomous systems segment, which they refer to as OAS. That segment is the sole engine powering this entire narrative shift.
And when we talk about growth, we're not talking about, organic slow scaling. We're discussing accelerating demand in the defense technology market, which has very high barriers to entry and usually pretty high margins. We saw a recent haul of orders exceeding $10 million for their counter-drone and robotic platforms. But the single detail that just screams validation is the $14.3 million order they recently secured for the Optimus drone systems. And that's from a prominent defense customer.
That $14.3 million isn't just revenue, it's a massive proof point. It tells us that a very sophisticated customer has vetted their technology and decided it's mission critical. And here's where the analysis gets really nuanced. The revenue they are generating isn't just arriving, it's exceptionally sticky revenue, and it's backed by a significant competitive moat.
Okay, let's drill down into that moat. What exactly makes this company so hard to compete with? Is it just patents, or is it something deeper?
It's the depth and breadth of their offerings. Their strength is not just building a single piece of hardware. It's the integrated multi-domain autonomy portfolio. They are combining counter-drone systems, unmanned ground vehicles, a core competency they got from the RoboTeam deal, and their specialized AI and security platforms all under one roof. They're selling a complete ecosystem. And this integrated approach creates immense switching costs for large clients, especially government agencies. Why? Because their proprietary tech, the FullMax software-defined radio platform, it adheres strictly to the IE 802.16T standard. Now, that acronym sounds dry, I know, but its benefit is critical. It guarantees high reliability and standardized interoperability. Government clients, critical infrastructure clients, they need tech that works seamlessly across various domains, and that standard ensures their systems integrate effortlessly.
So they offer a reliable, secure operating system that clients can't just, rip out once it's installed?
Yeah.
But there's also the regulatory side, right? That FAA certification for the Optimus system.
Absolutely crucial. The Optimus system was the first small unmanned aerial system SUAS to get FAA certification for automated beyond visual line of sight operations, BVLOS.
BVLOS, right.
And think about what that means. If you're an energy company needing to inspect miles of remote pipeline or railway needing automated track inspection, you must operate BVLOS. Clearing that regulatory hurdle effectively creates a massive, albeit temporary, regulatory moat. It completely locks out non-certified competitors from those specific high-value commercial use cases.
Okay.
So when you combine that regulatory advantage with their 21 patents and the current macro environment where the FCC is restricting foreign drone use, they've basically built a technological fortress that limits the runway for competitors like AeroVironment or Teledyne in these critical sectors.
So the technology is validated, the regulatory hurdles are cleared, and the demand is accelerating. That sounds like a powerful narrative. But let's introduce some skepticism, which is necessary here. Even with this explosive revenue growth, the company is still unprofitable, and that's always a red flag for a lot of investors.
It's a valid concern, but you have to look at it in the context of their balance sheet. While they are still burning cash to fund growth, they maintain a very robust cash reserve of approximately $432.82 million.
But isn't having $500 million just sitting there potentially a sign of I don't know, capital mismanagement?
Oh, yeah.
Or at least a delay in capitalizing on their growth? Why aren't they aggressively acquiring a crucial software firm right now to integrate?
That cash cushion serves two critical functions at this stage of development. First, it completely eliminates short-term liquidity concerns. It allows them to focus purely on converting that massive order backlog without financial panic. Second, it gives them immense firepower for strategic acquisitions when the right target comes along, ensuring they don't overpay. Plus, they have an extremely low debt-to-equity ratio of just 0.03. That gives them flexibility that a lot of heavily indebted competitors just don't have. This combination of explosive growth and financial stability is exactly why the smart money is moving in. If you zoom out a bit on the sector, the Q3 2025 13F filings showed massive institutional cluster buying. This wasn't one fund making a bet, this was multiple high-conviction players all initiating or significantly increasing their positions at the same time.
Let's talk scale, because
Yeah.
the accumulation data here is, well, it's astonishing.
It truly is. I mean, we saw Jane Street, one of the most sophisticated quant funds, add 8.49 million shares. That's nearly a 1,000% increase in their holding. Renaissance Technologies, another behemoth, took a brand new position of 8.34 million shares. And even the big banks are in on it. Morgan Stanley accumulated 4.67 million shares, which is an increase of over a Funday 62%. When you see institutional accumulation like that, you are seeing a vote of confidence that this growth story is sustainable, that the operational transition is real.
And that institutional conviction, it shows up immediately in the technical charts, which is fascinating for anyone tracking momentum patterns. The stock is showing textbook bullish action, consistent higher highs and higher lows since those order announcements. It recently surged 12.9% on the news, hitting $11.02.
Looking closer at the technical structure, the price action formed a classic cup-and-handle continuation pattern, right above a key resistance level. For momentum traders, that signals a high probability that the breakout is just getting started.
And beyond that short-term breakout, the stock is firmly entering what technicians call the golden cross phase.
Right. The golden cross is a powerful long-term signal. It occurs when the 50-day moving average crosses firmly above the 200-day moving average. It signifies that the short-term momentum has overcome the long-term trend, indicating a robust, sustained period of accumulation by large players.
We also need to briefly touch on the management changes, as that reflects their shift to a large-scale operational focus. The appointment of Brigadier General Patrick Houston as Chief Operating Officer, that's being viewed extremely positively by the market.
Oh, that move is strategic genius at this stage. You need to remember they are transitioning. They're going from being a nimble, R&D-focused small cap to a company that has to fulfill multi-million-dollar defense contracts. That requires high-level military and logistical expertise to ensure operational efficiency and timely delivery at scale. And Houston brings precisely that.
That said, we absolutely need to provide a balanced picture. For all the incredible revenue acceleration, profitability remains a huge, unavoidable challenge. Let's get honest about the risks. How does the market reconcile that growth with those, frankly, alarming negative margins?
It's the single biggest hurdle, and investors have to be clear-eyed about it. If you look purely at the financials, the net margins are sitting at a terrifying negative 402.42%. That explosive growth is funded by a high cash burn, which resulted in a net income loss of $38.01 million last quarter. And yes, free cash flow is still negative because every available dollar is being aggressively reinvested into R&D, acquisitions, and scaling up production.
So the immediate concern is, how long can they sustain that burn rate? And what tools does management have to raise capital if they need to?
Exactly. The primary tool is equity, which introduces the risk of share dilution. Investors should be aware of upcoming share issuances, about 7.7 million shares total, with one tranche already completed today, January 5th. This dilution risk might temper short-term momentum, even though it's necessary to fund their growth pipeline.
We also have to address the gigantic accounting item that caused some confusion. That $56.6 million non-cash charge that hits Q4 earnings. That number can scare off retail investors immediately.
It sounds huge, but the crucial context is that it is explicitly a non-cash charge. It's related to a notes exchange. It's an accounting cleanup move. It is not a spending decision. It won't affect their immediate liquidity or the cash they have available for operations. These risks, the burn rate, the dilution, they're largely priced into the stock. And they are significantly mitigated by that massive $433 million cash buffer we talked about. That buffer is their runway. It buys them the necessary time to convert that huge order backlog into consistent long-term cash flow.
So if the focus is on converting that backlog, What is the most critical event on the catalyst calendar for the next few months? What's going to confirm or deny their trajectory?
The single most critical event everyone is tracking is the Q4 2025 earnings report. We expect it in early February 2026. Because management already raised the full-year guidance to $36 million, the market is already anticipating another revenue beat for Q4. That report will either confirm the continued acceleration of the autonomous systems segment or signal a potential slowdown, which would really shake the institutional confidence we just analyzed.
And what about the bigger macro environment? Are there external tailwinds supporting this push?
The macro picture couldn't be stronger for this type of company. We are seeing a major rotation in investment favoring defense and technology companies right now, largely driven by escalating geopolitical tensions. That directly benefits their core offerings, counter-drone platforms and robotic systems. On top of that, the structural advantage from the FCC drone bans continues to funnel massive amounts of U.S. demand directly toward domestic players like Ondas.
That's the core thesis, distilled. The story for Ondas Holdings is a dramatic, high-stakes transition, moving from a speculative promise to a confirmed, tangible growth story, validated by enormous order flows, a growing moat, and powerful institutional accumulation.
And if we connect this back to the long-term potential, the real opportunity goes far beyond just selling individual drone systems. Given their strong push into integrated defense systems and those proprietary FAA certifications, you have to consider how significant the long-term, predictable, recurring revenue of its robotics as a service model, RAA, could be. I mean, think about the scale they're targeting. The total addressable market in autonomy is projected to hit $130 billion. If they can successfully execute on converting their hardware sales into long-term service contracts, monitoring, data analysis, maintenance, and capture even a small piece of that service market, that recurring revenue could fundamentally change their highly negative profitability trajectory over the next 5 years. It could move them into sustained positive cash flow. That's the potential reward you should be mulling over as you watch the Q4 results unfold.
That's the lowdown on Ondas Holdings for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.